Good morning, sir. Yes.
Good
Sir.
morning. I think we are into our last session. Uh, with this, we will be completing the discussion on the required materials for the exam. And I think the exam is planned to have in maybe, is it in January?
Yes, sir. 2nd
Starting
of
from
January.
2nd January,
So
sir.
it's January, yeah, January 18 to
Starting
16, right?
Right, right. So you already have a plan now, which means the timetable is out. So now we can target and work. With this session, as I said, we will be completing teaching, and I'm aware there are 4 revision sessions for this subject, starting from I think 27th. Then we already I think have covered some sort of exam questions also in the lecture series in terms of some questions taken in between. So I think you have some good preparation with the revision class. Also, you will have a I think very good understanding on the preparation for the exam. Mm, let me take you through this lecture today first. Now, today we are looking at financial system stability. Now, during all these weeks, we have covered uh, a kind of a detailed discussion on various components of the financial system, starting from the financial institutions, markets, products, infrastructure, uh, many aspects, and also money. And we discussed at the beginning also the financial system should not will not work properly unless there is some stability. So stability is one of the key concerns of the uh, financial system, the growth as well as its stability. Uh, I think yesterday the budget was presented. Day before, uh, even the budget has some proposals in terms of financial system. uh, we 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 will not have a separate session on that, but I think as students studying in financial subjects, you should have some understanding about the budget. There are various analyses published by various parties. I think you need to look at those analyses to get some feel about the budget as well, related to the financial system. And also there are, as I said, there are measures to strengthen the system as well, and also safety net mechanisms. So here we cover what is available right now in the economy in terms of financial system stability and the safety. What do you mean by financial system stability? As I said, I think we have covered this definition at the very beginning also. A safe, a secure financial system that is able to withstand external and internal shocks. A system is stable when it is having some resilience resilience to withstand or to face certain external and internal shocks. Every time, frequently, there could be various shocks emanating in the economy. These shocks could be arising due to internal factors or external factors. Now, these days, we have threats to the financial system, sorry, as well as to the economy due to both internal and external shocks. Internally, we know the growth is low. A lot of controls are there in terms of these health issues. and there are some stress in the market, in the in the foreign exchange market, in the rupee market, some stress conditions are there. At the same time, there are some external issues as well. We know the global commodity prices are rising right now. Gas, sugar, milk powder, all these commodity oil are rising at a faster pace. Global economic growth is at low levels right now. All these are shocks to an economy. So if these shocks are threatening the financial system, and if the financial system is not able to face these threats, we cannot say a financial system is stable. So it would be a stable system or a safe system if it is able to face any external and internal shocks without having any major failure or disturbance to the financial system. So in that sense, a stable financial system would indicate some certain, features. What are these key features? Or what are these, important aspects of the stable financial system? In such a situation, the financial institutions are stable. There are no major failures of individual institutions. In such a situation, there are no permanent or deep stresses in the markets. There could be, there could be one or two incidents having some stress in the market, but those are not long term or persistent or deep enough to threaten the financial system. There are no threats on the payment mechanisms. Payments are routed smoothly, settlements done, no dishonoring, everything is happening smoothly. The system runs smoothly. So those are the features of financial system stability, and also the confidence on investments, transactions, those will not be affected in a stable financial system. So such a system would create a favorable environment for depositors and investors. We know depositors and investors, they are the uh, fund makers in the system. Depositors, they mobilize money through their savings. Investors, they basically invest such excess money to make returns. For both, a stable financial system would create a better environment. Then the financial institutions and markets will function effectively and efficiently. If the system is stable and there are no disturbance, it will provide a good environment for financial institutions to perform their activities without any issue. They will be much efficient in the markets, very effective. And all in all, this would promote the investment and economic growth in an economy. So, for an economy, it is really needed to have a stable financial system, because we already know growth or the real economy and financial system are very much related. If there's any shock in the economy, that will be reflected in the financial system. If there's any shock in the financial system, that will be reflected in the broader economy. So both should have stability in order to promote investment and growth in the economy. People will not make any investment if the financial system is not stable. So stability is a really important concern. So as I said, there are few uh, characteristics of stability. On the other hand, if the system is not stable, it would be instability, and we would be able to identify some certain factors of instability. For example, if the financial system is not stable, we might be able to see some failures of financial institutions, mainly important, systemically important financial institutions. Large banks might collapse. Large financial services providers might collapse. During the global financial crisis, it happened. I think you may have heard a bank called Northern Rock. Northern Rock was the largest bank in US, one of the largest banks. It collapsed at the beginning of the crisis in 2007. Very famous investment bank, Lehman Brothers, that collapsed at the beginning of the crisis. So those are very important, systemically important institutions. Those get failed in a unstable or unstable or in a condition with instability. We would see large asset price volatility. Asset price means the prices of the financial assets. Could be bond prices, could be share prices, could be derivative prices, could be other forms of financial assets. Even the commodity prices could have this impact. Large volatility, prices would collapse very sharply. I think at the beginning of the global crisis, share prices crashed in a day, 30-40% crash in share prices. So that is called asset price volatility. Drain of market liquidity means there is no money in the economy because people won't lend, people won't bring money to the markets, people or the banks, they will keep money in their accounts without doing transactions. So that is reflecting or that is causing a drain in market liquidity, which means a dry condition, no money. So interest rate jack up, interest rate increase at very high pace because there's no money in the system. Disruption to payment and settlement system. So when there is no money, when there are collapses in the institutions, there could be some dishonoring of the payments. There could be some uh, blocks in the settlement systems. Blocks in the sense money. There's no money to settle. So that can happen in a situation of instability. And finally, and all in all, loss of confidence. When there is no financial system stability, the confidence on the financial system would be lost. We know the confidence is the most critical factor in a financial system because finance is involved in money, investment, transactions, all these. All are based on confidence. So if people don't believe the markets, the transactions, that the system's ability to fulfill the transactions, that will lead to loss of confidence. In the crisis in 2007, that was one of the major factors for the global scale of the crisis. People lost the confidence. No transaction happened. So that is very critical. So we need to have a mechanism to ensure the financial system stability. We have to make sure that financial system is able to withstand any shock. We have to make sure that financial system doesn't lose its confidence. We have to ensure that there is enough money, markets are functioning properly, institutions are functioning properly, efficiently. We have to ensure. How do you ensure there should be some measures in place in a financial system? The most critical or important measure in terms of ensuring the financial system stability is there should be proper risk management mechanisms in the financial institutions as well as in the markets. So risk is very common or inherited to financial transactions. The financial risk mainly. There could be other risks as well. We have covered these different aspects of risk, right? Operational risk, reputational risk, and all that. But we have seen the financial risk, the market-based risk is the most important thing. So institutions should have a proper risk management framework in place. Those risk management frameworks should be able to prevent any imbalances occurring in the system, or if there are any imbalances happen, this risk management framework should be able to correct it or to prevent any major disruption. So risk management is very important as a measure to ensure financial system stability, right? Risk management. Then regulation and supervision is really important. Now we know financial institutions or markets are supervised by an authority. Could be central bank, could be some other authority, right? So they do this regulation and supervision by way of monitoring, by way of putting controls, by way of introducing certain requirements for them to comply. For example, banks, a central bank would regulate by way of having minimum requirements for capital, for liquidity, for loans, non-performing loans. All these things are set up in a way that the bank should comply. They should adhere. And then the central bank supervises whether the banks are adhering to these. They go to the institution, we call it on site, or they look at from remote, which means off site. Both supervision methods would help whether the banks or financial institutions or payment systems are adhering to the regulations imposed by the regulator. Same with the stock market. In the stock market, Securities Commission would have regulations in terms of proper function in behavior of the institutions, trading. There are rules imposed in terms of trading in the stock market. And that is closely monitored and supervised by the authorities to ensure that there is no disruption to the proper functioning. Right? And then financial sector reforms are also important. Reforms means changes. Time to time, you introduce changes to the financial system, modifications, policy changes. Why do you need this? The economies keep change. The financial systems are dynamic. New risk, new developments occur. Now, for example, during last few years, we have seen there are some major or some alternative payment settlement mechanisms emerging. Virtual currencies are there, virtual finance is there, digital transactions are there, digital payment mechanisms are there, right? We talk about this artificial intelligence, big data. All these are new concepts. Those concepts have to be absorbed to the financial system gradually and strategically. For that matter, you have to introduce certain reforms, changes. For example, sometimes you might see a country has not allowed foreign capital to come in or go out. Maybe authorities would change that policy. It's a reform. Maybe some countries they don't allow digital transactions. After studying, they might be thinking of changing that policy. It's a financial reform. So reforms are really important. And then corporate governance. Good corporate governance is really important. Governance means systems, controls, and procedures to ensure that a institution is performing orderly. Those are some methods applied to ensure that institution is functioning properly without disturbing the market practices or other financial institutions. Crisis management policies, that is where the safety mechanism is important. Crisis management means there should be a mechanism. If you face a crisis, you have to have some mechanism to face it, to handle it, to manage it.
Sir, excuse me.
Yeah.
So I got a WhatsApp message from one of my friends. It says that amendment to the foreign exchange regulations. This was on 26th October 2021. As per that, it says Minister of Finance has decided to amend the foreign exchange regulation number 2 of 21 to introduce minimum investment threshold of USD 50,000 in the sectors allowed for investment without limitations or restrictions under the foreign exchange regulations, except for the tech start apps, ITES, and BPM businesses.
Hmm.
So, what does it mean, sir?
I'm not so sure
Yeah.
about the complete proposal. I haven't went through these proposals very carefully.
Uh
But,
huh.
but what suggests is, I think after listening to
They
your
want
thing,
more foreign the currencies, no, sir? That's what.
yeah, and also they are encouraging these technology related startups, isn't it?
Except for tech start ups, ITES and BPM business when a company is incorporated with foreign shareholding of 1% or more. These are exceptions, not for these sectors. That's
Yeah,
what it says
that's what
here.
I'm saying. That's what I'm saying. Exceptions means, in that sense, they are giving some, kind of a favorable environment for such institutions, right? Because startups, they are not able to, generate foreign exchange, or on the other hand, to pay taxes at a, significant scale. So some leeway is allowed for such institutions, right? Even in Sri Lanka, and not only this budget, in many cases, the governments have been thinking of promoting these technology-driven startups, uh, basically to promote this digital culture. Uh, that that is one of the key driving it, especially these business processing outsourcing, uh, other technology related industries, that drive is there. So that's what I said. uh, I couldn't go through these financial sector proposals very deeply. Maybe you need to look at these proposals which are very important for the uh, development and stability of the financial system. So most proposals are there in the budget to attract foreign exchange. Most proposals are there to ensure that companies are linking with foreign parties to bring capital, to bring technology, uh, in order to align with the new economic developments happening elsewhere. Okay, so what I was discussing, crisis management policies, these are actually uh, some mechanisms um, implemented by the financial system if there is any issue arises. Now, when there is a crisis, you should have some preparedness, how to manage it. During the global financial crisis, I think there was no, proper crisis management preparedness, no clear policies. There was no safety nets and contingency plans. Contingency means there should be some backup plans for the financial system. Safety net means there should be some mechanisms to safeguard institutions, depositors, individuals, payment systems, etc. Right? So those are really important factors to ensure the financial system stability. Now let's look at financial crisis in a little detailed manner because this is one of the key areas in your exam paper. Every exam paper has a reference to the crisis. What do you mean by crisis? Financial, it's actually extreme situation of financial instability. Now, in a financial instability condition of financial instability, you might be observing a couple of these factors. As I said, some liquidity is out from the market. Financial institutions show some vulnerability and all that. That can be corrected when you observe the instability. But if it is not corrected, if it is going worse, and if it is compounding, then it could lead to a crisis situation. Instability could lead to a crisis situation. So, in a crisis, what happens? Financial assets suddenly lose their value completely or part of their value. Now, for example, in this chart, I have Dow Jones Industrial Average Index, that is the stock market index for US. During global financial crisis, I told you, look at the price index before the crisis, it was around 14,000. It was here. All of a sudden, within a matter of few months, this index fell almost by 50%. Now, which means, for example, if your share price was at 1,000 at this point, your wealth is decided by this 1,000, right? Then your price has collapsed by 50,000 means your share price becomes 500, which means your wealth is eroded by 50%. So this is an outcome of a financial crisis. Asset prices largely fall. So financial markets and institutions experience large disruption. Sometimes even the financial markets stop collapsing, stop functioning in such a situation. So ultimately, this would lead to or translate into economic crisis. Why? When financial markets are not functioning, when there are disruptions to the payments and settlement mechanisms, when people's value is eroded, economic activities will be affected. That would lead to an economic crisis as well. So global financial crisis occurred in 2007. We call it as an economic and financial crisis. Global financial and economic crisis. Why? It led to a full-scale economic crisis across the world. All these advanced countries, UK, USA, Canada, Australia, New Zealand, European countries, all these countries encountered a deep recession, economic slowdown during the global financial crisis. So a crisis is really a costly and a painful situation. Why a crisis could occur? There are various reasons for a crisis. In other words, how this financial instability would lead to a crisis because of these factors. One factor is leverage. Leverage means high borrowings. People borrow to finance financial investments. During global financial crisis, people borrow largely, not only for financial investments, they borrow for, especially for mortgage investments, to buy houses. Excessive borrowings. People borrow, that's a normal thing. But if you take a balance sheet and if you observe a particular company, almost 90% of their funds are borrowed funds. That indicates some risk. If you are an individual, you borrow, and let's say you have some assets, house, car, whatever. 95% of these are obtained through borrowings. That is risky. You call it leverage. So high leverage could lead to uncontrolled debt levels. Right? That is one factor. The other factor is high credit growth. Credit growth is required for an economy because credit is basically financing the economic activities. If people want to do economic activities, start businesses, start factories, productions, and all that, you have to have credit. But if that credit is growing at an exponential or high growth, that is risky. For example, an economy would require 10%, 15% credit growth. If credit is booming at 30%, 40%, 50%, then that is risky. Why is that? The high credit growth would lead to high property prices. People would demand property using this credit, and even the property prices increased. There is a situation in the economy that increase cannot be sustained or tolerated. Then it start collapsing. In the global financial crisis that happened, there was high credit growth and people started borrowing, and they invested those borrowed funds in mortgages, houses. So house prices went up substantially in US, and house supply was also increased because you have more credit, you build, you supply more. At one point there was a situation that supply exceeds the demand and prices start collapsing. During the at the beginning of the crisis, there was plenty of properties available in the US economy without any occupancy, which means there's no demand. Then prices collapse. When prices collapse, you are not able to pay your debt, then the financial institution also in trouble. Asset liability mismatch, which means assets means what you have in your balance sheet under your name. Liability means what you need to pay. So if there is a large mismatch between these assets and liabilities, that could lead to a crisis. Sometimes you have large liabilities, short term liabilities. You have to pay in 1 year or 2 years' time. Whereas your assets are long term, you don't get enough cash to pay. Then such situations could lead to mismatches and collapses in the financial institutions. During the crisis, there was a very clear case: regulatory failures. Regulatory failures means the authorities do not have proper mechanism, sufficient mechanism or rules to regulate financial institutions and markets. There are large loopholes. There are large inefficiencies, and there are large areas that is not under the purview of the regulator. They cannot do anything. So such regulatory failures also impact the institutions and markets, leading to a crisis. Weak management. That is also one of the key reasons for crisis. There was a Singaporean bank sometimes back, Barings Bank, very famous bank. The Barings banks entirely collapsed due to weak management. Weak management in the sense it was basically controlled by one or two persons. There was no proper internal controls, no governance, no proper risk management mechanisms. That led to the crisis. Even in the global financial crisis, some institutions collapsed due to weak management. So all these factors that I have mentioned here are actually from actual experiences.
So,
But
excuse me.
yeah,
Now in Sri Lanka, sir, now Pramuka and Selinko. Now is this the same issue, sir?
same.
Same, no? Right.
Yeah, Pramuka Bank entirely due to weak financial management and no controls and all that. Right? Other institutions I don't want to comment because some are actually still in operation or trying to revive. There are a lot of issues,
EAP also, sir, same thing, I think, no? EAP group,
mostly.
yeah.
So these factors, causes and consequences of financial crisis, would be compounded and would be creating a damaging effect due to this contagion. Right? Contagion means what? The crisis spread from one institution or one country to others, other markets, disturbing the entire market and the country. So contagion leads to systemic risk. Contagion means simply it's spreading. A problem in one institution could spread. So during this issue that you mentioned during the Pramuka Bank issue, it did not have a contagious effect. It was managed. But if it was a large institution like a state bank or a large bank, what could happen? There could be some contagion effect. It spread to other institutions as well. Why? The transactions and the these payments are linked between the institutions. So that we call as systemic risk. So during the global financial crisis, the crisis occurred in US, spread to other countries, Europe, and also to other advanced countries, even to emerging countries because of this contagion effect. So I think this question from 2019 semester 1, you will get some idea. The question asks, briefly discuss cross-border contagion risk with respect to 2008 global financial crisis. So there we have first defined the contagion. Cross-border contagion means spreading the market disturbance from one country to the other country, or from one country or group of country to other set of countries due to interconnection between the markets. These markets are interconnected because borders are open. Borders open in the sense you can do transactions with foreign parties. So that leads to cross-border spreading of the risk. So as I said, although the 2008 financial crisis occurred in USA, especially with the bankruptcy of the Lehman Brothers, it spread to other countries like Europe, Asia, Latin America because of the cross border connections, exposure to the US financial institutions. So, contagion has to be contained or controlled in order to ensure the financial system stability. So, here I have just outlined some, textbook analysis to give you an idea about the steps of a crisis, to show you that crisis does not happen suddenly. When there is a crisis, you have some indications, you have some signs. Now, for example, let's say if someone gets a heart attack, it doesn't happen overnight. There are some indications. Over the time, there would be some signs that you will have this issue at some point. If you address those signs then and there, then you minimize that risk of having the heart attack. But if you ignore it and you allow it to aggravate, then at certain point that would trigger. So same with the financial system. You would see some early initial conditions of a crisis. Now, if you look at this chart, you will see at the early stage, you will see financial institutions' balance sheets are getting weaker. Getting weaker means you have large defaults, you have large provisioning, asset quality goes down. Those can be observed at the beginning. In the markets, asset prices decline, stock markets collapse, decline, other interest rates would show some volatility, some uncertainty would be observed, right? People are not so sure what's happening. So that is stage one. In the stage two, it will lead to a kind of a banking crisis. What is the banking crisis? Economic activities would be slowing down, people would default, there would be some issues in the financial and payment system. Now it is getting aggravated. In the third phase, then you will see all these financial institutions are in trouble. They are not able to do transactions. Economic activity collapses because there is no support from the financial system. There's no way to have transactions effectively. All these lead to some stress condition in the financial market and the economy. So a crisis would be progressing in different stages. In other words, you have ability to prevent it without allowing it to be aggravated. And there are various types of crises. In the history of economy, global economy, we have seen there are a number of crises happen in many countries. There are banking crises, which means a bank suffers a sudden rush of withdrawals by depositors, leading to a bank run. Bank run means bankruptcy. If all your depositors come at once and ask for money because of loss of confidence, then it could lead to a crisis. This happened in 1930s. People rush to banks and they withdraw all money, then the banks collapse. Then the second type of crisis is a speculative bubble. Speculative bubble means some asset prices increase at high speed or large scale. For example, in the stock market, you see a large boom. Booms can happen in the stock market, but it should be supported by economic factors. If economy is booming and the stock market is booming, then it is, there is something relation. But economy is negative, stock market is booming means there should be something else. People speculate. People over investing there. Some assets are overpriced, imbalances. So in such situation, a speculative bubble could happen, and that could lead to a crisis. In the global financial crisis, it happened. These mortgages, they were overpriced. Why? Because of easy credit, people demanded credit to build houses or demand houses that jack up prices substantially, and then subsequently it collapsed. Third type of crisis, currency crisis. So we talked about banking crisis, speculative bubbles. Currency crisis. Currency crisis means if a country does not have lack of foreign currency, that could lead to a currency crisis. This happened in East Asia around 1997. You may have heard East Asian crisis or Asian financial crisis. That is actually due to lack of foreign exchange or foreign currency. During this Asian financial crisis, at the beginning of the crisis, money invested by other countries, foreign currency, were withdrawn by the investors and taken out from these East Asian countries. Thailand, Indonesia, Malaysia, these countries face a severe crisis because of that. Sovereign debt crisis. Some crises occur due to inability of the countries to pay their debt. Sovereign debt means public debt. So countries like Latin American countries, Argentina, Venezuela, these countries face this sovereign debt crisis. Even in Europe, we saw a sovereign crisis around 2009-10 period due to inability to pay back their sovereign debt. These could lead to an economic crisis as well, which means negative GDP growth for few quarters. During global financial crisis, we have seen this economic crisis as well. The global economy went into negative territory. Actually, not the entire global economy, the advanced economy especially. They experience a negative economic growth because of this depressed condition. So in the annex of this slide set, you may observe I have given some examples for these crises. For banking crisis, currency crisis, debt crisis, I have given more details and examples, right? So I advise you to look at that. So here we have listed those crises.
Excuse me.
Yes.
Yeah. Sir, excuse me, sir. Now, with respect to this sovereign debt crisis, sir, now there are so many gossips going around relating to Sri Lanka also.
Mm.
So, any comment on this, sir? Now, don't know whether it will affect us as a sovereign debt crisis.
Those are some extreme comments, no? Because we have been able to pay our debt. This year we have paid, I think, more than $5 billion, and upcoming debt payments are also basically planned how to pay them, and there are plans to raise money. Uh, and also the important factor is we have been passing most stress conditions in the history in Sri Lanka, but we have never defaulted any debt, right? Since our independence, all these liabilities have been honored without any failure. Some countries, they have failed to pay, like as I said, Argentina, they defaulted. But even we face severe stress conditions, especially during the wartime. We have never defaulted as a country. So I think some of these comments are really extreme. Right? We have a stress situation, that is true. Because especially because of the crisis situation, COVID crisis, we know there is an issue. Foreign currency does not come to the country. There are, exports are, now only picking up. Uh, and also on top of that, internationally, global commodity prices are rising. You have to pay more to import. For example, if you want to import oil, you have to pay more, right? Foreign currency. So there are some stress conditions, that is true, but still with that stress conditions, uh, the government has plans to raise money then and there to pay the debt without any failure. Okay. So here we have some examples for major crises in the history. The first crisis we observe, actually the major scale crisis occurred in 1929 here, uh, around this period. You call it Great Depression. Okay. From this chart you can see almost 50% of the countries of the world, they have been affected by this Great Depression. So this started with the stock market crisis, stock market collapse in 1929. Then there was a major crisis in 1973, oil crisis, because oil prices went up substantially after forming the OPEC cartel. So that led to a crisis at the initial phase. In 1980s, in this area, Latin American countries face a debt crisis. As I said, countries like Argentina, they defaulted their debt for the first time. Government did not pay their debt. In 1997, as I said, the Asian financial crisis happened. It was a very severe crisis. After 2000, again, you can see this line is going up, means more countries affected due to the crisis under this global financial crisis. So then in 2010, as I said, European debt crisis also occurred, which means countries like Greece, they defaulted paying their liabilities. Right? So you can see it's a kind of a cycle in the world. You will see crises are occurring time to time. But the good thing is, after this Great Depression, the entire world got together and managed without having any crisis for nearly 30-40 years. But during 80s and 90s, you can see the crisis, the magnitude has gone up. So these crises, I have given you some details in the annex for you to read. How it happened, what are the causes, that is for your knowledge, because we will not be discussing these every historical crisis in your exam paper. But Probably you might have reference to this global financial crisis happened in 2007-8 period. That we need to have some understanding, right? So global financial crisis started in 2007-8 period, and it is considered as the worst crisis since the Great Depression in 1930s. Because during the Great Depression, a large number of countries affected. Similarly, in the global financial crisis, a large number of financial institutions around the world was threatened. So that led to collapse of large financial institutions, decline in wealth. As I said, if the stock market is crashed in a day, you lose your wealth. And that led to a global economic recession in 2009-10 period. Still, we have the legacy impact of this crisis, right? When the whole world was recovering out after this crisis, we have seen another hit came, pandemic. So that has affected the global economy, which was recovering at that time. So with the global financial crisis, we have seen securities face large losses, as I said, bond prices, equity prices, they face large declines. Credit was tightened means banks did not give credit. There was decline in liquidity. And when the liquidity is declined, no credit is available, economic activities get disrupted. So international trade also declined during this period, and that contributed to European debt crisis as well. So what are the reasons for this crisis, 2007 crisis? There was large number of reasons, especially crisis occurred due to easy credit. I told you in US people were very conveniently borrowing from the financial institutions to buy homes. So home ownership was the key motive during that time using easy credit. Easy credit means the interest rates are low. Banks are giving loans, very freely in the sense without having much credit appraisals or without considering the risk or whatever any issues. So people borrowed easily and invested in the housing market. So house prices went up. As I said, when the investment started, house prices going up. Then at one point, large number of houses, the supply was there, and that exceeded the demand. When the demand is low, now what happens? The prices start collapsing. So these house prices went to a peak, then started collapsing. So by 2009-8 period, 2008-9 period, the house prices have fallen by 30%. So this led to a crisis in the subprime market in the US. Subprime market means we call it subprime mortgage market, the housing market in US. So with this, we have seen increased securitization is there. We discussed securitization, remember, under the derivatives. Securitization means bad assets were taken into another institution or another framework, and you sell those bad assets to others. So even the bad assets could not be sold during this crisis. And there are some allegations on questionable trading practices. For example, investment banks, they were doing some activities against market practices, insider dealings. Those were among few factors behind the global financial crisis. So crisis led to a financial panic in US in 2008. The subprime crisis occurred in the housing market, but as I said, it spread to other financial institutions, investment sector, banking sector. A lot of stress occurred during that time in the US economy. Not only in US, it damaged financial institutions globally. A large number of banks collapsed. I will show you some details. Number of banks collapsed during this period. Stock markets crashed. Securities, they suffered large losses. So everywhere we have seen this stress. It translated to a global economic stress due to this US crisis. So you can see the impact. These are US bank failures during 2006 to 2019, 13 period. Starting from 2008, you can see, especially 2009, 10, 11, this much of banks collapse in US. Right? Can you imagine? More than 140 banks in 2009, 2010, more than 157 banks. These banks mean small, large, different sizes. But these banks collapse during this period. This is only in US. So this translated to other countries as well. So what was the impact? Global trade went to negative. Global production, industrial production went to negative, right? Which means a recession condition. As a result, for the first time after depression, we have seen global economic growth went to negative levels, especially in the advanced countries. You can see this red line is the advanced countries. So advanced country economic growth went to even negative 6%. It's a large decline worldwide. So just, 10 years prior to this pandemic, we have seen experience this crisis in a global scale. Equity market collapse. I told you there's a large drop in equity prices around this 2009 period. Interest went up substantially. So this volatility graph shows interest increase substantially with high volatility. So this is the crisis of impact of the crisis. Both governments and central banks responded to this crisis because it was a global scale crisis. So the entire economies, especially the advanced countries, they mobilized together to combat the crisis. So large fiscal stimulus were given. Fiscal stimulus means governments expanded their spending in order to prevent the economic crisis. Monetary expansions were done, which means large amounts of money were injected to the economy through this quantitative easing and credit easing. So these I have covered actually under money. What is quantitative easing, credit easing? These are called as unconventional monetary policies. I hope you remember unconventional monetary policies. And also countries were having these bailout mechanisms. Bailout mechanisms means failing institutions were saved by the government intervention. So using taxpayers' money, governments in US, UK, they saved some large institutions. They call it nationalization of these institutions using taxpayers' money. So if you look at this table, programs by types by the country, Canada, France, Germany, all these countries, this is in European area, large number of policies have been used to save the banks, right? In addition to these fiscal and monetary stimulus, large programs were there to rescue banks from failing. As I said, consequently, or little time after the global crisis, a European debt crisis also occurred, especially in countries like Spain, Portugal, Greece, Ireland, Italy. They faced a severe crisis showing that they are unable to pay back their debt. Especially countries like Greece, they defaulted. And for the first time, they defaulted paying to IMF also. Their loans to IMF, not only for other countries. IMF loans were also uh, defaulted. So in 2012, Greece government has the largest sovereign default in the history. Large amounts of money defaulted. But to prevent this crisis, many other countries came into front, especially global institutions like IMF, European Central Bank. They adopted large measures to prevent this crisis. Even today, European Central Bank, they keep interest rates very low. And also even some cases it's negative in order to support the European economies. You know, European economies are much integrated through this European Union. They use as common currency, most these countries, apart from UK. So they use that European Central Bank monetary policy to have low interest rates and money injections to the European economies to recover from the crisis. And the latest crisis we are facing is the COVID pandemic. We know COVID pandemic also affected the entire globe. After the global financial crisis, we have seen in 2020, the global economic growth was negative. Especially in advanced countries, the negative growth was very large. Even emerging countries face this risk. Although we expect some recovery this year and next year, at the beginning of the crisis, we face severe stress. Especially the financial markets were affected. At the beginning of the crisis, you can see from this chart, the stock indices collapse substantially. So there was around 30-40% drop in the stock market at the beginning of the crisis. Volatility in the markets went up substantially, increased interest rate volatility during the pandemic. And central banks and the governments, again, they responded. Like in the global financial crisis, in this case also, central banks and the governments responded. Especially central banks responded very sharply. They injected large amounts of money to the economy. Interest rates have been brought down to zero levels. If you look at during the 2008-9 period, so interest rates were kept very low to come out from the crisis. Then again, we have come to that situation. So this very similar to a situation of global financial crisis. Interest rates are very low. Large amounts of money is injected to the economies. Lot of concessions have been given. Direct cash transfers have been done. Lot of relaxations in terms of regulatory relaxations have been done in order to safeguard the financial system during this crisis. So one of the good things compared to this global financial crisis, the pandemic impact is not that long. We have seen the financial market was severely impacted by the crisis, but later on it has recovered, right? So I think that's an indication that countries have adjusted in the face of pandemic. We know with this vaccination, new normal, distance, keeping distance and all that, social distancing, people have basically engaging in economic activities, not like in the global financial crisis. So that has led to some recovery compared to the global financial crisis, right? So this discussion is basically on the uh, crisis and related concepts, especially the financial system stability, its importance, how do you ensure the stability? If you don't ensure stability, what will happen? It will lead to a crisis. What is the impact and the causes of the crisis? And how do you ensure that you do not allow a crisis to happen? And if a crisis happens, how do you overcome? So these have been covered in this part. In the last part, we will look at safety nets and the regulation. Financial system safety nets, we call them as FSSNs. They are very important to maintain the financial system stability. So what is a safety net? It's a safeguard. It's a kind of a protection. A very good example for a safety net is, I think you may have seen these circus arenas. In circus arenas, people who perform circus in the air, very high levels, they have a net underneath, a safety net. So if they are fallen from their performance, they will be basically protected or captured by the net. Similarly, in a financial system, you have safety nets. They are safeguards to stabilize or to ensure the financial system to perform normally in a distress situation. What are the components of this safety net? Regulation and supervision is there. Capital funds is a really important requirement. Lend of last resort is an important component of safety net, and deposit insurance and liquidity support scheme. So these four are really important items of a good safety net in a financial system. Why this safety net is there? To ensure the financial system is stable. Okay, let's look at these briefly. Regulation means, I think I mentioned to you at the beginning, those are some rules, procedures, guidelines, requirements imposed by the central bank or any other regulator. So why do you need to have a regulation? You need to safeguard depositors. You need to safeguard the financial system. We need to ensure that institutions have good risk management practices. Good governance practices are there. And also good discipline, market discipline is there. Disclosures are there. Disclosure means you basically publish information. And there are no unlawful activities like money laundering or terrorist financing. That is also part of regulation. And also fair treatment for the customers. Consumer protection is also important there under regulation. So here I have taken some exam question related to regulation. Briefly discuss single regulatory model and multi-regulatory model by providing example. In a single regulatory model, you will have only one regulator. In Singapore, they have a single regulatory model, which means all financial institutions are regulated by one institution. Banks, non-banks, credit unions, other type of forex dealers, security dealers, security market, EP, provident funds, all are regulated by one single regulator. Insurance, that is Singapore model. In a multi-regulatory model, there will be more than one regulator, like in Sri Lanka. In Sri Lanka, we have few regulators. For example, for the banking sector, non-bank sector, primary dealer sector, we have the central bank. For the capital market, central bank doesn't do anything. It's the Securities and Exchange Commission. Stock market is regulated by them. For insurance, there is another regulator in Sri Lanka, Insurance Regulatory Commission. So it's a multi-regulatory model. So both these are in place in countries. So I think in the next question, what I have mentioned is proved. List institutions or markets fall under regulatory and supervisory purview of the central bank and SEC. I told you under central bank, there are various institutions, the banks, finance companies, leasing companies, primary dealers, money changers, even microfinance institutions, those are coming under central bank. And also the payment system. There are large number of payment systems, RTGS, slips, this is not slips, right? All these are under central bank. Securities and Exchange Commission, you call it SEC, they regulate the stock market activities like stock broking, stock exchange, stock dealing, rating agencies, the depository, all these are under the Securities and Exchange Commission. In regulation, we have two approaches, micro regulation and macro regulation. You call it microprudential regulation and macroprudential regulation. Microprudential means you regulate, supervise, or control individual financial institutions. I think if you are from a bank, you know, the central bank is regulating you individually in terms of your activities, your transactions, your behavior. The central bank has given you directions. There are some laws. The banking law is there. Business, finance business law act is there. Leasing act is there. Insurance act is there. Likewise, there are various laws. You call them as primary regulations. Based on those laws, authorities issue directions, determinations, circulars for you to comply. You call them as secondary regulations. And also under these secondary regulations, various requirements have been imposed by the regulator on capital, liquidity, provisioning against bad loans, etc., etc. So all these applicable to individual financial institutions. So by microprudential regulation, the central bank will ensure individual financial institutions are safe, right? 1, 2, 3. If you take 3 individually, they are safe. Microprudential regulation. So macroprudential regulation considers all these together. So financial system is taken as a whole. We know in the financial system there are banks, non-banks, insurance, stock market, what else? Forex market. Now in in macroprudential sense, the authority will look at as a whole or as a major chunk of the financial system without going to individual levels. So both macro and microprudential regulation is needed for financial system stability. I hope you remember we discussed macroprudential tools central bank can impose macroprudential tools to ensure this entire system is safe. If it is issuing a particular rule or guideline targeting one institution or in individual institutions, you call it microprudential tools. Macroprudential tools are aiming at the broader system. And the capital funds in institutions are required to keep an adequate level of capital, maintain an adequate level of capital. Now, this is really important, very important for banks and non-bank institutions. Capital, why do you need capital? Capital is considered as a cushion. Let's say if there is a shock, people default their loans, and such loans, when they are defaulted, you have to have a mechanism to absorb it. What is the mechanism to absorb? You have to have some buffer to absorb such shocks. That buffer is created by capital. So under Basel requirements, as I said, banks should have strong capital level. Now Basel 1 is completed. Basel 2 is completed. Now at the moment, most banks are complying with Basel 3. So under this Basel 3, the capital strengthening is really emphasized along with liquidity. So this is capital requirements in Sri Lanka. Capital requirement is actually can be identified as two types of requirements. One is regulatory capital and the capital adequacy. So under Basel III requirements, all banks in Sri Lanka, they have to maintain these capital ratios. So regulatory capital is divided into two types, tier 1 capital and tier 2 capital. So under tier 1 capital, you basically consider equity. I think under banking subject, you study this thoroughly. I'm just giving you some overview for you to say that there is a capital requirement that the bank should follow, and these are the types of requirements. So banks, shares, reserves, these are under tier 1 capital, and also banks have preference shares in their balance sheets. That is also coming under tier 1 capital. Under tier 2 capital, they can include debentures as well. So this regulatory capital ensures, it's a ratio, right? It's a ratio. It ensures the banks will have a minimum capital at every time to face any shock. So that is measured by this capital adequacy ratio. So in this right hand side formula, we have the capital adequacy ratio that is taken as capital divided by risk weighted assets, right? Assets are taken with risk weights because different assets have different risk. Loans have a different risk, investments have a different risk. You take those risks as well into consideration when you compile these capital ratios. Now here we have an example from exam paper. A bank's total risk-weighted assets and the total capital asset this date is 15,500 and 2015 respectively. Compute the total capital adequacy ratio of the bank. So total capital adequacy ratio, in short, we call it CAR. How do you calculate CAR? Capital divided by risk-weighted assets. So 2015 divided by 15,500. So the bank is having around 13% capital. So assuming that you should have a minimum of 10% CAR, the bank is having 13%, which means greater than the minimum. So that indicates the bank is having a good capital ratio. How this capital ratio is augmented? Banks do some allocation for reserves. Without distributing profits, sometimes bank keep some retained profits to strengthen the capital. You can issue shares to bring more capital. You can issue debentures to bring more capital. So that is to ensure that you have a minimum in the case of a large issue problem. Other one, as I said, minimum capital amounts. So this one is ratio that you have to maintain all time. Minimum capital amounts means the bank should have an amount in terms of money, not the ratio. For example, if a new bank to be started in Sri Lanka, if it is a domestic bank, domestic LCB means domestic licensed commercial bank, you should have at least $20 billion rupees to start a bank. That is the entry capital. This is entry capital. If it is a specialized bank, you have to have 7.5 billion. If it is a foreign bank, you have to have a 10 billion minimum. You can ask for a license if you only have this amount of capital. So this has been imposed by the central bank by 2020, but given the crisis situation of the pandemic, this has been extended to 2022. So banks should comply this by 2022, which means existing banks, they also need to fulfill this requirement by 2022, which means if it is a domestic private bank, they have to increase their capital up to a private or state bank, they have to increase their capital up to 20 billion by 2022. If it is a specialized bank, they have to increase their capital up to 7.5. Foreign banks, they have different classification. If it is having assets up to 100 billion, their requirement is 5 billion. If they have more than 100 billion assets, their requirement is 10 billion. So this should be maintained in money in their balance sheet, the minimum capital. Okay. Lend of last resort. I think we discussed this concept under monetary policy as well. Last resort means you don't have any other option. Let's say a financial institution is experiencing a difficulty and they are not able to borrow from the market. They are in a really a distress situation, about to collapse. So in such situation, in order to safeguard the system and retain the public confidence, a central bank can provide lender of last resort facility, which means you provide some funding, short-term funding for them to manage their liquidity. In Sri Lanka, the Central Bank of Sri Lanka provides this lend of last resort facility under the bank rate. There's a monetary policy instrument, remember, called bank rate, which means providing money to financial institutions when they are at a distress situation. So this is common in many central banks. They have this facility. Now even countries can ask for last resort facility. For example, now let's say a country is unable to meet their liabilities, then they don't have money, they can go to IMF and ask for a loan. It is also a lender of last resort facility. So this is given at,
Excuse me, sir.
yes,
What stand for IMF?
International Monetary Fund. Okay, got
Yes, sir.
it?
Thank you. Yeah. Thank you.
International Monetary Fund. Then the other safety net is the deposit insurance and liquidity support schemes. Now, in most countries, they have this deposit insurance scheme. Deposit insurance scheme means if a particular taking deposit taking uh, institution like a bank or a non-bank collapses, in order to retain public confidence and to protect them, there are mechanisms to pay them back. How do you pay? The banking sector creates an insurance scheme. To that insurance scheme, everyone contributes, every bank or maybe non-banks also part of that. They contribute and they grow a fund. Using that fund, you can repay for the depositors of failed institutions. Now in Sri Lanka, licensed banks, both the commercial banks and specialized banks, as well as finance companies, they have insured their deposit liabilities under Sri Lanka Deposit Insurance and Liquidity Support Scheme, SLDI LSS. This is operated by the central bank. So every bank and non-bank should contribute to this fund. So they have a premium to pay. Right? For licensed banks, they have to pay 1% of their 0.1% of their deposits if their capital is above 14%, which means they are strong. If you are strong, you pay a less premium. If they are less strong, your premium is little higher. For finance companies, the premium is higher than the banks. So they pay 0.15 of the deposits. So using these contributions, the deposit insurance fund is built and accumulated. When there is a failure of financial institutions, central bank use these funds to pay such institutions. Now I think you are aware these days, central bank is paying for some deposit holders of failed finance companies. We know a couple of finance companies have failed due to various reasons. And using these funds, depositors are basically compensated. Now, this compensation can vary time to time. I remember a few years back, the maximum compensation was 150,000 rupees. Now it has been increased to 1.1 million rupees per deposit.
Excuse me, sir.
Yes,
I got to know it's 1.5 million, isn't it? Or it has been changed again?
1.1, not 5. Who told you 1.5?
Uh, I was learning financial, non-banking financial business. So those days I was getting ready for exam, but I didn't. Because of the crisis, we didn't face that exam.
Mhm.
So those days I got to know. Anyway, by mistakenly I think I can remember. Anyway, that's I will take it as
It was
1.5 million.
increased from 600,000 rupees to 1 point.
1 million is it?
Yes.
Okay, thank you.
So that is the maximum. You may be having number of deposits amounting to 2 million, but you will only get a maximum of this if you have any deposit in a failed institution. So this is a kind of a protection for the financial for the depositors. On the other hand, in from the same fund, you can support the banks as well or the non-banks as well through this liquidity support. So liquidity support is given to the institution. Deposit insurance is given to the depositor or the client. Okay? This is a very good mechanism to support the both the institution and the client. And through the premiums, this is growing. And when it grows, the authorities can decide to change the uh, compensation. Now here we have a question related to this financial system safety net. This is from 2019 paper. If you look at this fourth question, that is related to Sri Lanka Deposit Insurance and Liquidity Support Scheme. So you can answer these questions. I just mentioned some of these answers. Licensed banks, what is their reporting frequency? Do they report monthly, quarterly, or annually?
Quarterly.
They have to report quarterly, exactly. Finance companies,
Monthly.
they have to report monthly. So capital adequacy ratio is given for banks. For non-banks, it is not applicable. What is the premium if there is if their capital adequacy is more than 14%? I just mentioned
0.125.
0.1 for if their capital is more than
It
14%.
depends, no, sir?
Yeah. If it is less than 14%, then 1 point, sorry, 0.125. Got it? So depending on this capital ratio, this 0.1 or 0.125 is applicable for banks. For non-banks, what is the ratio? I just mentioned 0.15. So their ratio is little higher because their risk is much higher compared to banks. What is the maximum compensation? I just mentioned right now
1.1 million.
1.1. At the time of this exam, it was actually 600,000. So in your marking scheme, you would see it is 600,000. Okay. Then I think the first question, number 2, that is also related to regulate ratios stipulated by the central bank under these safety nets. So the question is, what are the regulatory ratios stipulated by the Central Bank of Sri Lanka to assess the financial soundness of licensed banks with regard to the following? Minimum of 5 regulatory ratios should be listed to get full marks. What are the ratios you can mention here? In terms of capital adequacy, you can say Tier 1 capital adequacy,
Tier 1 and Tier 2.
Tier 2, and taken together, you can call it total capital adequacy. So that covers three ratios: Tier 1, Tier 2, and CAR. So if you write these three, you get you cover three here. In terms of liquidity, in Sri Lanka, we have statutory liquid asset ratio, SLAR, statutory liquid asset ratio. And under Basel III, there are some new liquidity ratios as well. For example, liquidity coverage ratio, LCR. I'm not going to discuss the definitions of these ratios. I'm just mentioning. Under leverage, there is a ratio called leverage ratio. So these are some regulatory ratios applied in Sri Lanka. Now I also added, this is not actually part of safety nets, but I added this considering it is very important for effective functioning of these safety nets. What is this? Awareness. So awareness is a key component of financial system stability. Why? If you do not have proper awareness, you will be basically getting into some distress situation in a financial system. Because there are various activities happening in a financial system. If you don't have any awareness, you might be basically be in trouble. And also, if you don't have awareness, you will not be able to exploit the opportunities in a financial system. We know in a financial system, there are various opportunities in terms of instruments, institutions, there are various avenues. You have to have some knowledge. You have to have some knowledge how to make money, how to make investments, how to do some genuine investment, how to avoid financial scams. You have to have some knowledge. There are various scams, right? Unauthorized deposits, pyramid schemes, illegal marketing activities. A lot of things are there in a financial system. I know a lot of people get caught into these, especially with these pyramid schemes, network marketing activities. A lot of people get caught and they lose money. So people should have some good awareness to avoid these things. For that matter, the Central Bank of Sri Lanka is conducting awareness campaigns based on various approaches. The Central Bank publishes this financial system stability review. One of the key publications of the Central Bank to give some idea about the entire financial system, its components. If you look at this stability review, you will see that it's written in a nice way to give you a comprehensive understanding about the markets, institutions, payment infrastructure, global financial conditions, local financial conditions, and all. So this is one of the key mechanisms to improve the awareness. And central bank always talk about financial scams, right? Putting advertisements, TV programs, awareness, interviews, discussions, every time. And even for unauthorized financial activities, the central bank is always giving you a thorough awareness. But unfortunately, people sometimes, having listened to all these things, still they do the same, right? So, as students and also responsible citizens, we should take these messages very seriously and avoid such. Uh, Give me a minute, please. Hello. Mang kata. Right? So we have to ensure that we have proper awareness and we avoid such unlawful activities, financial scams, and all that. Last thing I wanted to highlight to credit rating. Uh, I added this thing because you should have some understanding about credit rating. It's an evaluation method, right? The credit rating can be given to a country, can be given to a company, a bank, or an instrument. Even the instruments can be rated. What do you mean by credit risk? Credit rating. It evaluates whether there is any risk of default, right? Credit worthiness, in other words. So if a particular institution is able to pay back without any issue, without any problem, you have a good evaluation. If you are unable to pay back on time in proper way, that indicates you don't have a good credit worthiness. So this rating is a mechanism to evaluate that credit worthiness, how significant your credit worthiness, whether you are in a good position or a bad position. So there are some methodologies applied by, there are various credit rating companies operating in the world. The most famous credit rating agencies are Moody's, S&P, Fitch. All these are operating in Sri Lanka as well. Fitch has a Sri Lankan uh, office as well. So they evaluate your ability to repay based on a matrix and they assign some ratings. In general, any rate, now different companies have different rating notations. We call them notches. So these A type of notches indicate you are in high grade or prime grade, right? If you are in B area, that indicates you are in the middle, right? Not so good, but still you will be able to repay your debt. If you are broadly in C area, that indicates some risk, right? You have some, some risk, some issues, some uncertainty in relation to your credit worthiness. If you are in D category, that indicates you are having some bad credit worthiness, which means you are not in a position to repay. Okay, so this rating is very important for investors. When they invest money, they look at where is your rating, whether you are A or whether you are B, whether you are able to uh, basically handle your credit, repay your credit on time. So this is very important indicator. I think even the banks, they look at this indicator when they invest in other investments. When they look at international investment, they look at this rating. Okay. So with that, I think we have covered our discussion. As I said, I have given you some details about these crises: banking crisis, speculative crises, currency crises, sovereign defaults, decisions, and also some examples in the history: Wall Street crisis, oil crisis, Latin American debt crisis, Japanese asset crisis, Asian financial crisis, Russian crisis. Those are some additional information for you to, go through for your knowledge. But what I have covered in the main slides are related to our discussions or the exam evaluations, right? With that, I think we have covered our materials. I think during last 11 sessions, 11 sessions in the sense we have covered 11 sets of uh, materials, handouts. But for some weeks we have covered, I think for some sessions we have spent more than 4-5 weeks. So I think we comprehensively covered our materials during our discussion, and I tried to make it very detailed and comprehensive for your knowledge. So with that, we complete our teaching session, right? And as I said, I have given you some handouts for additional reading, for money, for financial sector, for payment systems. I have given you some additional notes as well. So please go through them for additional knowledge and so for some clear understanding. And then we have already covered most of the exam questions in our discussions, right? Time to time we have taken these questions. And then the upcoming revision will be used to have a kind of a revision of all these materials in line with the exam papers. So in the revision class, we will basically look at the questions from the exam paper with some, revision to key things, not the entire, discussions that we had. Mainly some few areas will be revised for your knowledge at the revisions. That's all what I have to say. Do you have anything to clarify or ask? Any comment?
Sir, just for knowledge, just I need to know why these gas price also increased. No, so that also kind of the crisis, or is there any mafia?
It's actually global prices rising. No? If you look at global prices, let me share a chart if it is possible. There's a clear pickup in global prices. Do you see my screen, Google screen?
Yeah, sir.
So can you see this chart?
Yeah, I understood.
See the gold, iron, soybeans, meat, which means agricultural products, copper, oil. See the jump in oil from $25 in mid 2020 to $75 by this year. Almost $50 increase. This is only oil, right? Oil, gas, all these, prices are picking up internationally. So I think that gives you the answer. Clear, Quilini?
Yeah, sir. Thank you.
Okay, so there's no mafia, nothing. Only thing what we have done is we have not adjusted our prices according to international prices. That was the issue. So we did it lately. When there was a shortage only, we adjusted our prices.
Excuse me, sir.
Yes.
Are you facing a currency crisis?
I think same question was asked by someone else at the beginning, which means lack of foreign currency. But as I said, there are a lot of measures to mobilize currency, and we have seen some good signs as well. Now, recently we have came to know this Bangladesh facility was basically, in line, and there are a lot of facilities discussed among Chinese counterparties and Middle Eastern counterparties. I think we have some good signs that we will get, adequate currency for our, requirements. In immediate future, we don't have large liabilities to pay. We don't have. We only have, I think, in January there is a payment, large payment. So for that matter, we will be able to mobilize money. So there is no such, kind of a risk of a currency crisis. But as I said, these stress conditions can occur at any time. We have been facing this stress condition in 2019, 2015. A similar situation, our reserves went down. We were under real, stress, but still we were able to mobilize money. Now, I think with the opening of the country, tourism is also now picking up in November and December, January. Those are good months for tourism. With the vaccination rollout and with the, adjusting to a new normal, things are getting, normal. So with that, we are expecting that we will receive some foreign currency. So I think, and also there is a great effort by the central bank to attract remittances. I think you may have seen recently the central bank established a remittances department, remittances, related financial products, right? So a lot of efforts are going on. So there's no risk of a currency crisis. Okay.
Okay, sir. Thank you.
Hello, sir.
Yes. Any more questions?
Yeah, I have received a message from News First. So it says when we do the exports, so there is some kind of charges or applicable for that. What's that, sir?
For charges
When
for exports?
yeah, I have received a message from News First. Uh, just they are mentioned like that. So I didn't go through that. So just to know about the information.
I'm not aware of such, charge for exports, but only thing, exports proceeds have to be converted within a certain time frame. That requirement is there. When my exporters export, they cannot keep that in foreign currency for, longer period. Within 180 days period, they have to convert, and central bank has imposed some percentages to be converted, right? So that
Yeah,
requirement,
that's the thing. That's the thing, sir.
yeah. Other than that, there's no charge. Okay, I think we can conclude, and officially I should extend my gratitude, thankfulness to you for being very interactive students, and I really enjoyed this class Sunday morning, even though it's really a difficult day, Sunday in the morning, but we managed to cover our materials and discussions without any failure, very comprehensively, and that was supported by your interaction as well. We had a very good interaction every time, discussions, sharing views. That's really good, and I think we have successfully concluded our discussion. We haven't seen each other in this class. I think most of you I haven't seen except for your, photographs. Maybe I'll switch on my video, at least you can see me. right? But we were able to cover our discussion very effectively. And I think our revision sessions are also will be online, but surely we will be meeting at IBSL at one point, at least at your convocation. So please feel free to talk to me, introducing yourself, saying that you were in my class that day. Thank you very much. So it is the time to conclude, and we will meet in the revision session as well.
Thank you very much, sir. The way you have delivered lectures is also so attractive. So this is not just for exam. This is very good for, for the general knowledge, as citizens of the country. So really, really good, sir. The way you have shared information, global economy, Sri Lanka. So these things are really good, sir. Thank you very much. Really appreciate the way you have delivered it. Thank you, sir.
Thank you, Quilini. Lalani.
Yes, I also saying the same thing because all the people that we are bankers. We even though we also thinking how other people, the normal people are thinking the what's the government doing, what's the central bank is doing. But once we started to follow this course, we got to know what is government is doing for the people. Then what is the central bank is doing for the people. So we can get an idea what is our country is doing. So that is exactly good, even for not for the exam. Even that's great because we who don't know, even we don't want to follow the central bank link. Those kind of things I have never follow. So once I joined this class, I really enjoyed. So I usually like to always I'm going to follow all the things whatever the even whatever the links or books I like to read much more. So I really enjoyed this class, and I really anyway I try to when you are saying something I try to do and try to fulfill that. So anyway, thank you very much.
Thank you, Quilini. All the best. And Lalani, thank you very much for your comment. And I'm sure you will do
Actually, I
best.
work as a human resource manager, so this is a new area for me. So I
Okay.
wanted to sit for this exam just to just because since I'm from a banking industry, just to
Hmm.
gain knowledge, not just to pass exam. So I think this is a really good good decision made by me, sir. Thank you very much.
Okay, nice to hear. Thank you very much.
Thank you for the session, sir. Actually, within your session, I have got many answers for the unsolved problems when occurred during my banking career. So thank
Mhm.
you for that, sir. Thank you very much.
Thank you, Chatura. All the best. All the best. Okay.
Thank you very much, sir. And Pratibha,
Yeah, Pratibha. Thank you.
uh, thank you very much for your great contribution, and your teaching method is brilliant, and I like it very much. And you always encourage us to read materials and also to prepare the exam. For the everything, thank you very much, sir.
Thank you very much for your comment, Pratibha. All the best. And I'm sure all of you do well, and don't worry about the exam. I think what we have covered, and from your feedback, I understand you have taken them very well, so you will be fine. Only thing you need to do some preparation for the exam. That's all. Okay, then all the best. We'll meet up at the revision session. I think we have roughly 16 hours revisions, 4 hours every day, and I'm sure we will be able to have some productive time there as well. So with that, I think you will be completely prepared for the exam. Okay, all the best. Stay safe, and we'll meet soon. Okay, thank you.